I was raised in a middle-class family. I was told that the recipe for success was go to school, get great grades, you're going to get a good job, and life would just work out. It was right then, Rod, that I just realized, I wasn't going to get wealth.
I think a lot of people walk with those blinders on. They don't recognize that you have to create your own security. I've heard that now our national debt's going up $1 trillion every 100 days.
This put me on this obsessive quest to really figure out how are the top 1% really building their wealth. But I had the opportunity to invest in all kinds of asset classes: retail, raw land, single family, office, multifamily, oil and gas. Had really great success over the next 20 years. What if I told you you could reduce your costs by 10 to 20% by reducing your taxes?
Welcome back to Lifetime Cash Flow through Real Estate Investing. I'm Rod Khleif, and I'm thrilled you're here. Got a super cool guy I'm interviewing today. I've been on his podcast. His name's Dave Wolcott. Dave's pretty much every asset class in real estate. He's raised almost $100 million for real estate. He's the CEO of Pantheon Investments. It's pantheoninvest.com. And I was on his podcast, which is Wealth Strategies, Secrets of the Ultra Wealthy. Good to have you here, brother. Good to see you.
Yeah, look, grateful to be here. Always great to connect. And,
And you're going to be moving in right down the street, on the same street that I'm on, no less.
100%. We're officially neighbors. Yeah.
That's crazy, crazy. Well, I appreciate you coming out, brother. And I'm a little jealous because of some of the things I've heard before we started recording here, of the way you've approached this, because talk about the right way to approach this. But listen, I'm not going to steal your thunder. I want you to tell your story, and then let's dig in on stuff.
You bet. I think it'll be helpful to provide some context really about my story. And I was raised in a middle-class family in Connecticut, and I was told that the recipe for success was go to school, get great grades, you're going to get a good job, and life would just work out, right? So kind of followed down that path. I had the opportunity to do the ROTC program in the Marine Corps, serve my country, and really learn some things there, Rod, that they don't teach you anywhere else in life. Things such as leadership, teamwork, and integrity. After the Marine Corps, I transitioned into corporate America, got into the tech industry. And at the same time, my wife and I started raising a family. We had an 18-month-old running around. And then on October 24th, 2000, we literally had triplets.
Oh, holy cow.
Yeah, holy cow is right. And so we quadrupled the size of our family overnight. And here I was just trying to figure out my career. But the first thing I did, Rod, was I went to see my financial planner and said, it's $1 million these days to raise a kid. Now that's 4, plus I've got retirement, and I wanted to live a big life, right? And the financial planner just told me that, look, max out your 401k, defer your taxes, right? For the kids, there's things like 529 plans. And it was right then, Rod, that I just realized, I wasn't going to get wealthy, right, as a retail investor in the stock market. And this was average advice for average people, right? So this put me on this obsessive quest to really figure out how are the top 1% really building their wealth. And I tried to decode that. So I started investing in private deals. And keep in mind, this is back in 2000. Rich Dad, Poor Dad just came out. There weren't great podcasts like this or resources. But I had the opportunity to invest in all kinds of asset classes: retail, raw land, single family, office, multifamily, oil and gas. Had really great success over the next 20 years in all these asset classes, and built a tech business on the side, which I had a full exit. And then I created Pantheon really to help other people figure out what is the blueprint of the ultra wealthy. How can we, achieve our goals in life, much quicker using the real estate asset class, other asset classes? How do we need to be thinking about our wealth? And, how can we just live the best life that we want to live?
Okay. When did you start Pantheon?
Started about 5 years ago.
Let's talk about some of the things you do inside of it. I know you have a virtual family office. Explain, versus a brick and mortar situation, or?
Yeah. So it's interesting, Rod, right? Like I'm really focused, just like you are, right? I'm focused on our investor, right? And as an entrepreneur, I see it as solutions, right? So where are people struggling with not meeting their goals, their financial goals, whatever that is, right? So we have a podcast, right, that creates education for people to learn, right? Education is a huge part of that. As you go through that journey then, and you start to learn how the ultra wealthy are investing, what is the asset allocation model they have? Well, they've got a certain amount in real estate, they've got other asset classes. They might need help in terms of, okay, I'm too busy, right? I just sold my business, I made 8 figures, and I'm too busy to chase down all these deals, right? We don't have enough time. So that's where a virtual family office can come in and help give you guidance and really act like a CFO, to kind of plug you in. Other things, for instance, right, such as strategic tax planning. It took me firing 5 different CPA firms over the course of building businesses over the years, that I got completely frustrated that all the 95% of the advice out there is just it's for average people, right?
So if you're driving, looking in the rearview mirror.
Yeah. Yeah, exactly. They're filing your taxes, right? They're not doing strategic tax planning, right? And so that's huge. So you want to be able to plug into a network of these strategic advisors that can really help you accelerate your wealth as well as preserve your wealth.
And that's part of your family office program?
Correct.
So you got tax planning there. You're identifying opportunities for you to invest in. I know you've co-invested in lots of deals with some big names that we talked about before we started recording, and people I know quite well. I think you mentioned life insurance as well, a whole life.
Yeah. Now, again, so let's just think about that from a solution perspective, right? And I know there's a ton of real estate, investors in your audience, right? So that's how I actually discovered using cash value whole life insurance policy. Is we start getting income from our different properties, right? And what do you do with that income, especially when you're starting out? Might not be that much, right? It might be a couple $100 from each property, a couple thousand here or there, but you don't have enough to have the down payment for that next deal, right? So what you want to do is actually add velocity to your money, right? So by putting it inside of a whole life cash value policy, what you can do is that money starts compounding tax-free at just about a 6% rate. It also, you can use it as collateral against loans. So you could actually purchase real estate using it as a collateral base, and you can borrow against the policy to go make your next purchase and basically use the same dollar twice. And there's probably a dozen other things that it does. And this is one of the things that the wealthy do really well.
Help me understand something, though. You said use the same dollar twice. You lost me on that.
Okay, so this is what's really sophisticated about this, Rod. So let's say I put $100K into a policy this year.
And you're not limited by how much you put in, correct? You can pretty much stack it up if you want.
Yeah, you can stack it up on the front end, exactly. Like if you had an exit or liquidity event, right?
Okay.
But let's just say you put in $100K right up front, and then typically, within 30 days, you can actually borrow, up to maybe 75, 85% of the value that you've actually put into it. Right? So that 100K is going to continue to compound at just about a 6% rate, completely tax-free, while I've then just borrowed 80K out of it, and now I'm using that for my next multifamily deal as part of the down payment or something.
How does that look?
So you have a loan, so...
Was there? I mean, I assume there's an interest rate?
Yeah, there is an interest rate, but there's always a spread. You have like a half point to a point spread typically. So that way, you're always able to basically, be ahead.
So is the interest rate on the borrow similar to what you're getting as the return on the initial 100,000? Just excuse my ignorance on this. I'm just curious.
Yeah, no, the interest rate, like I said, is usually about a point or half point below what the interest rate is, and that's much more, or what you're making on it. So
Got
again,
it.
say
Okay,
it's 6%, you're maybe at 5%. So you have a little bit of a margin, right, arbitrage that you have. But if you think about, you take out that 80,000, it's now in a real estate asset, which you can multiply at multiples. But at the same time, you still have that existing principal of the 100K. Plus, don't forget all the other benefits. Like, people are raising families. You've got a death benefit attached to that. Right. You have also, estate planning, right, where it can go to your heirs completely tax-free and avoid probate. It's got asset protection. So if creditors come after you, they can't see it.
So that return that they get on, I mean, sorry to belabor this topic as much as I am, it's just my own curiosity. That return they get, say that 6% on their 100,000, how is that generated?
Keep in mind that insurance companies a mutual insurance company has been around since the Civil War. Right. Okay, so they've seen all kinds of ups and downs in the market. So therefore, how they allocate capital is so conservative. Right.
So it's from their investments.
Exactly.
Yeah, insurance companies loan
bonds
money.
And bonds, very low risk investments. So that's how they're
Warren
making
Buffett
returns.
Started out, I think, was he bought an insurance company, and that provided the cash flow to get things rolling.
Yeah. So you can use this very synergistically, right, with real estate in terms of, like I said, adding more velocity to your portfolio, adding dry powder. Like, where do you keep your dry powder, right? We're coming into this, market, right, where there's going to be some really great buying opportunities, but you got to be able to be liquid to do that. And I don't know about you, I don't want to keep my money in banks anymore.
Right.
Right. So
not with a third of the commercial debt held by small and regional banks, and office occupancy at 60% nationwide. I mean, we're going to see some bank unrest. We're going to take a break from this great episode for a word from our sponsor, which is the Multifamily Bootcamp. Now, financial success is what you're after. We are rapidly approaching one of the greatest opportunities I think we're going to see in our lifetimes to capitalize financially. So if you know real estate is the vehicle for you, you're crazy not to spend a couple days with me at one of my boot camps. I've always got one right around the corner. Thousands and thousands of people have taken action on their journeys to creating generational cash flow for themselves and their families from attending my events. I don't sell anything at this event, so it's basically 16 to 18 hours of training with nothing being sold. Kind of a no-brainer if you're serious about this. To check it out, text the word links to 72345 or go to rodslinks.com. Again, text links to 72345 or go to rodslinks.com. I promise you'll be glad you came. Let's get back to it. I put my money in a bank that spreads it out over 80 banks and doesn't put more than $250,000 in each bank, so it's covered by FDIC. So I know you wrote a book, The Holistic Wealth Strategy. I've got a page tagged here that's got some great points for me to ask you about in the book. Talk about it for a minute.
Yeah, so again, Rod, this is really about kind of helping, investors, and whether you're an active investor or a passive investor, it's really, the focus is to distill all these myths that we have about wealth, right? And how can we really get to our goals, much faster, right? So dispelling some of the, myths about traditional financial planning type things, how do you incorporate, real estate into your, overall plan? And it really has just 5 simple phases to it. And it's all underpinned, Rod, which I know you're a huge goals guy. Right. So it's all underpinned by creating your own strategy, right? Because if you don't have a target, you're going to miss every time. Sure. So getting crystal clear clarity on what is your vision.
Yeah, no, it starts with that for sure. I mean, that's the first thing we do at my boot camps. I just did that with the virtual boot camp. I mean, how do you get anything if you don't know what it is? And we've got my Orlando event is coming now. We should have over 1,000 people there. And that's the first thing we'll do is goal setting. I mean, you got to create that burning desire. I see in your book you've got your why. You've got to know the why. Otherwise, it's the why that drives you. So, I see some other things in here around growth mindset. And I don't want to steal your thunder, but let's talk about some of these things. Beliefs, health, habits. Do you want to elaborate
Yeah,
on some of that stuff a little bit?
Sure. Phase one really starts with mindset, because I can tell you, you're never going to get out of the gate if you don't have a growth mindset. If you have a fixed mindset and you're talking to your financial planner and you say, hey, I want to go, buy a next multifamily deal, what's he going to tell you? That's too risky. You shouldn't do that, right? What is all your family and your friends going to say? Shouldn't do that, right? And so we need to be in this position where we're always asking why. We're asking a lot of questions. We're being very curious. And then we're trying to figure out, based upon our vision, right, how can we get there? So setting goals and habits to really support that. But it all starts with having the right mindset, because I've talked to so many people, and I'm sure as successful as you are, right, I can guarantee you've had conversations with people at, some events or whatever outside of real estate that say, seems strange. You're not invested in the stock market, because really Wall Street wants us to think the only way to invest in this country is stocks, bonds, and mutual
Nobody's
funds.
Stupid enough to come to me with that. If they know me at all. No, because I can obliterate that conversation.
Yeah.
But, that sounded very egotistical. But the bottom line is no, people don't come to me and say, why aren't you in the stock market? Because I'm going to tell you, if what I think is going to happen here sometime in the next, I don't know, year, 2, maybe 3 years, when we have a reckoning, the first thing to crash is the stock market, and we'll see bank failures if that happens, and so, yeah, no, I don't. Anybody I talk to, I tell them, get your money out of the stock market right now. Get into fixed assets, because inflation's not going away. I mean, I don't know if you knew this. I told you before we started recording. I've heard that now our national debt's going up $1 trillion every 100 days. In the last 4 years, they've printed 80% of our money supply. So up to 2020, 20% of the money was in circulation, and now they've increased it by 80%. Hello, and we wonder why we have inflation, and I don't think the Fed can do a thing about it. So I think there's going to be a reckoning at some point, but definitely not in the stock market. So the next piece of this is learning and team building. You want to elaborate in your book, rather?
Yeah, absolutely. So in my journey, like I said, back in 2000, I took the purple pill, right, from Kiyosaki, and, the cash flow quadrant was brilliant, but it didn't really give you a roadmap on where to go. What do I do with this?
Great strategy.
This is fantastic. Right. But, I'm constantly pouring through books and meeting people, right, and trying to grow and trying to learn all of the time, trying to find, those resources. So you really have to look at yourself as the number one asset and be investing in yourself. And I have a little equation to kind of make this real for the audience, Rod, which is your net worth is equal to your financial IQ plus your mindset IQ plus your physical capital, plus your relationship capital.
Love it. Yeah, I see here health IQ. Yeah, no, I got it. I mean, I couldn't agree more. And see, the problem is they don't teach you this stuff in school.
No.
Even in college, and so, don't get me started on that. But people just don't know. They don't know how to handle their finances, and they get sucked into the matrix like my dad did. Go work for a company, worked for Continental Airlines for 36 years, said, yeah, I'm going to get a great pension, was dogging me when I was doing real estate. I love him, don't get me wrong, and I miss him terribly. But my mom got $597 a month from his pension, and he worked for Continental Airlines for 36 years and got laid off. So, thought he had job security. And I think a lot of people walk with those blinders on. They don't recognize that you have to create your own security. You have to build your financial IQ. You have to build, that mindset, like you said, IQ. And then, of course, it all ties into health. I mean, if you don't have the energy to do this, I've got students that have retired from extremely high-paying jobs with kids, with consuming jobs, and they do this stuff on the side. But it takes, if you don't have the energy to do it, that takes incredible energy to grind for a few years, like most people won't, to live the rest of your life like most people can't. You do infinite banking?
Yeah, that's the whole life insurance.
Oh, that's the
yeah.
whole life insurance.
Yeah.
Okay. So I think we touched on the next piece, but let's just see if we missed anything. It talks about tax strategy, infinite banking, and then estate planning. Is there anything we didn't cover in our previous conversation as it relates to that?
Yeah, no, I think that's a good foundation. And then we really move. So, we started with mindset, just as a refresher, right? Then we talked about education, right? And all these different areas.
Self-education.
Yeah, self-education, exactly. And then we move into phase 3, which is, we're not only trying to grow our wealth, but we want to protect our wealth as well. So we need to create infrastructure around that. I like to call it infrastructure because there's some plumbing, there's some stuff that's not all that fun, like asset protection. But I guarantee you, no matter what your net worth is, if you're raising a family, you've got to have some asset protection in place. And not all of these things are the same, right? If you're a real estate investor, you're an LP investor, you're going after some big assets, you better make sure that you are covered, right? You've got an increased risk profile, you've got higher net worth, things like that. So asset protection is key. Estate planning is key. I know all of your audience are family people, right? We're thinking about future generations and really, just like you, we want to make the world a better place, right? So how do you do that with proper estate planning? Because it's not just about passing on money, but it's passing on values, setting up a family constitution and things that really matter, within families. And then, of course, the biggest one, Rod, right, is having a proactive tax strategy that we talked about a little bit earlier. And if you think of it this way,
forward-thinking tax strategy.
Yes, think about it this way, right? Everyone is always thinking about yield. So I can get a 15% IRR on that deal. My money's working, right there. Okay, maybe the next one is 16%, and we're always trying to increase our yield. But what if I told you could reduce your costs by 10 to 20% by reducing your taxes, right? And then that's perpetual. So now you add that 10% on top of your 15% you're making. So now you're at 25, 30%, and then that just keeps compounding every year. It becomes really significant. So as I said, I've fired, many different, CPA firms over the years. We're all in real estate, but you still have to understand how to use that. You have to be educated. You have to have the right partner to be able to do that. But I think that it's a significant opportunity for most people out there.
Oh, no question.
Yeah.
I mean, there's a reason, 90% of the world's millionaires either made their money in real estate or invest in it after they make it, because the big reason is the tax benefits.
Yeah.
We talked about asset protection. I want to elaborate on that for 1 second. When you've got a decent net worth and you're a limited partner, LP in deals and things like that. I mean, I see LPs invest in deals in their personal name rather than like a holding company LLC and things like that. Yeah, that's the kind of stuff we're talking about here. They're not protected if it's in their own name personally. And I remember, I took it to a whole nother level back in the day, an offshore trust and all sorts of crazy things, land trusts, regular trusts. This is pre-LLCs, and it was limited partnerships back then. But you're walking around with a bullseye on your forehead, and you've got to think about this stuff, in advance. So the next thing you've got here is asset repositioning. Do you want to speak to that a little bit?
Yeah, this is where it starts to get fun, Rod. So most of the time I talk to, new investors, and, and let's face it, over 90% of America, they have their money tied up in two places. It's in government-sponsored qualified plans, or it's in trapped equity in their own primary residence. Because we were under this, false notion that paying off your home mortgage is a really good thing to do. But as savvy investors, we all know that the rate of return on equity in your primary residence is zero, right? So there's typically some opportunity there. And, just to give an example, right, let's say, you pull out, take a home equity line of credit, even at today's rates, say 8% or something, pull out that capital, you're going to now increase your amount of, income, taxable you deductions that you have in the house, right? So that goes down. You actually reduce your exposure liability in the home as well, because now the bank owns more of the house than you do. So you're protected against creditors. And now I could take that 8% and then arbitrage it and say, for instance, we have a credit fund, right, that's investing in merchant cash advances. You could make a 15 to 20% return and basically over double your money just by being smart about it. Right? So that's a big opportunity for people, is to take a look at their existing portfolio and look at assets that are lower yielding and move them to a higher yield and lower risk.
That fund you just described, could you elaborate on that a little bit more? What is it?
Yeah, so merchant cash advances, this is a really interesting asset class. It's got 20% combined annual growth the past decade, new asset class. And what's happening is with the banks tightening regulations and everything, right, they're not able to lend to small businesses. So basically these other providers, so we're on a platform that can essentially do factoring and provide lending to, let's say there's a restaurant here in town, right, in Sarasota. They've got 3 different locations and now they want to open one in Naples. Well, you go to a bank, they might not even get approval, funding, anything. We could underwrite this inside of a week. They've got a $400,000 loan. Put up a new flag down in Naples. Now they're producing revenue, and they pay back principal and interest payments on a daily and weekly basis. So the money gets, the velocity of money here is so fast. It starts getting returned because the average loan is only 7 months. And so you can do a nice double-digit return. With cash flow, it's non-correlated to the markets, and it's also very diversified because we're investing in different industries and also only taking a small position in each one of the loans.
Okay, that last piece made me feel more comfortable. You talk about a restaurant, huge failure rate in restaurants, so that made me a little nervous.
Yeah, 100%.
I don't want to put bad information out there.
So the default rate on the fund we're working on, it's been around for over 6 years. It's less than 6%.
Okay.
And that includes COVID.
Okay.
Right?
Okay. All right. That's not bad at all.
And we can collateralize. The other thing is we collateralize equipment. Most of the deals are collateralized or personal guarantees.
Well, I had a restaurant and I had equipment, and I don't want to belittle what you're saying here, but when you get this equipment, it's not worth much afterwards. But so and so you also talked about targeting IRAs, which is kind of a no-brainer. If you've got an IRA, you can invest with that. And then some of the things that you're investing in, I know you're in multifamily. You mentioned you're getting into oil and gas. And are you in any, and besides this merchant cash advance, or really merchant lending, really, any other asset classes or any other things that you're doing with people's
that's a
money?
great question, Rod, and I'm really glad that you asked that, right? Because I think, when you follow family offices, right, and centimillionaires, and you really study portfolio allocation thesis and really understand this, there is what we call this concept, I think, of diversification is used incorrectly in the stock market, right? Because it really becomes diversification because you're investing in so many different assets across so many different things, right? But what you see the ultra wealthy do really successfully is they concentrate on typically, 1 to 3 different sectors, and then they diversify inside those. So for instance, for multifamily, for us, we'll look at multifamily, but we're going to diversify between markets, return profiles. Like we just did a 380 unit condo building in South Florida, build to rent. Totally unique product, right? Versus a value add, right? In Texas, things like that. So we focus on real estate, private credit and debt, and we focus on energy. And one of the reasons why we like energy as well, we have this oil and gas fund, up to 92% year one investment offsets active income.
Yeah, it's
so the high income earners, it's beautiful. Pays out the passive income really well, right? And again, back to your point of printing $1 trillion, right, in debt that the government keeps spending, this is a great hedge against inflation, right? And to get some exposure to a commodity where demand is always growing.
How's it a hedge against inflation?
Because would you rather have exposure to a commodity, right? Because
So
the
you've got
commodity,
ownership in a commodity. You're actually
it's a
buying
working
the commodity.
interest in oil and
In
gas.
actual oil.
Yeah.
Yeah, I do, have a friend that did something in oil and gas and just got his butt handed. Well, he's not a friend, he's an associate, but he had his butt handed to him. But I don't know the details of it at all. But I mean, like anything, everything has risk. We've got a lot of multifamily operators in trouble right now. I told you before we started recording, I'm taking over 23 assets, and some of those are in trouble. And I've got unhappy investors, that I've been asked to step in. Don't have an ownership interest in the worst of them. But it's some crazy times right now. There's some people struggling in these different things. So talk about your team for me. I mean, you've got a relationship with strategic tax planning, which I love. I may want to talk to you about that myself. What other components? You have an underwriting component. Talk about that a little bit. That you're underwriting these deals.
Yeah,
Are you
so
doing it yourself?
I have a full-time portfolio manager that was actually a wealth advisor for well over a decade. Then he spent another decade in private equity doing acquisitions and things. So he does all of our due diligence, underwriting, when we're looking into deals, which some operators don't have that,
Right.
When they're even co-GP. So we spent a lot of time doing that. And this is a relationship-based business, right? So I spent a lot of time myself with family offices and PE groups actually trying to get exposure to what I call invisible deals.
PE
deals
is private
that nobody
equity,
sees.
guys. That's just PE is private equity. I'm sorry, I interrupted you.
Yeah,
I
no
just wanted to-
problem. It's all about trying to find really great deals for us that basically nobody can see, right? Because once it's on the market, everybody's got access.
Sure. Well, that's great. That answers that question. And like on my team, I've got a freaking rock star underwriter as well. Wrote our software that my students use, and it's a critical piece of this. I mean, our business, a lot of our business is empirical. It's numbers, and then asking all the right questions and looking at trends. And I want to flag something you said and draw attention to it, because you're dead on in that the really sophisticated family offices they'll focus on one asset class, maybe two at max, and then they're inside of that. They focus, and even Napoleon Hill in his book Think and Grow Rich says, don't be a generalist, be a specialist. And I'm even talking to my team about it, because we're in multiple markets and we want to hone in on one or two markets and just own those markets. And the truly successful operators, that's how they play. And it's the same thing with family offices. Like I remember Richard Wilson talking about, certain family offices focus on this, so they focus on that. So if you bring them something that's not in their wheelhouse, you're just wasting your time and their time. You really need to ask questions to discover what they want. Would you agree with all that?
100%. If I brought to our investors the greatest biotech deal,
Right.
I mean, it's just not going to make sense. No one is really educated on that. And, I think a lot of syndicators are doing it wrong out there, right? Because they're very transactional in nature, and it's like, let's go do this asset, let's go do that asset, and how are they getting any leverage, right?
Or true expertise.
Exactly.
Because they're trying to be all things to all people, and that's the mistake. I've built 28 businesses in my career, and I call them seminars when they fail, and several worth, tens of millions of dollars. I got 3 right now that are, but most are spectacular, flaming seminars because, I didn't focus, and focus is power. And so that's what we're talking about here is focus. So, if you're listening, you've got to pick your vehicle. You've got to decide how you're going to capitalize on, what I think is coming economic uncertainty, but also, how you're going to invest and then learn that vehicle. Don't be lazy. If it's going to be multifamily, get your butt to one of my boot camps. But if not, then go learn whatever it is you're going to invest in. I mean, would you agree with that? I mean, you educate your investors as well, yes?
100%.
Yeah.
And I think this is a really great way to sum it up. Is that we're all looking for great assets to invest in. but look internally, right? Because there's no bigger investment than yourself, whether that's your health, your relationships, your education, because I've always achieved a 10x, a 100x multiple on that investment. So, if you're in multifamily, really carve out that niche that you are going to be the best at, right? And figure out what that is. And
even if you're
there.
investing passively, at least have basic understanding. That's what I'm trying to say here, and you take the time to educate. You've got your book. It's on Amazon, The Holistic Wealth Strategy. I know you've got a mastermind as well. And you, by the way, it's pantheoninvest.com. And we do the same thing. We add value. We try to educate and give people comfortable so they have an understanding of what they're investing in. And if it's multifamily, I'd suggest you come to my boot camp, honestly. Yeah, it's 3 days, but don't give your hard-earned money to someone unless you have a basic understanding of what the hell you're investing in here. But listen, brother, it's good to see you. I appreciate you coming in. You've added a ton of value, and I can't believe you're going to be right down the street from me. That's crazy, but it's good to see you again, man.
Yeah, always great to connect, Rod. Really appreciate you. And I really appreciate your mission as well, because you're helping so many people, again, really decode this. And because this is self-education. We're not taught this anywhere. So definitely invest in Rod's boot camp. You can't get this information anywhere else.
Yeah, no, I appreciate that. Again, if it's not multifamily, decide what it is and learn it. That's the key here. Bottom line. Well, it's great to see you, Dave. Thanks for coming in, brother.
Thanks again, Rod. Appreciate it.